This is part two of the statement of cash flows. Specifically, the focus is going to be on operating activity section using the indirect method. And as you can see here on the left hand side, there's an exhibit here of the income statement and balance sheet that's from the textbook. And I want to use these two statements in order to actually prepare the statement of cash flows using the indirect method. So on the left hand side, well, first off, the indirect method, I don't want to jump ahead. So I'm going to put over here the indirect method. Under the indirect method, you're going to start off with presenting the net income from the income statement. And that's going to be $38,000. So we see here on the income statement, the bottom line is 38,000, but there are various accounts that affect the bottom line. We have sales, cost of goods sold, operating expenses, depreciation expense, etc. Our job is to figure out the accounts or items that doesn't affect cash but did affect the bottom line, which is the net income of $38,000. So what did affect this amount, this $38,000, that is not cash or non-cash, that didn't affect cash? So because we're going to have to make an adjustment to this net income balance in order to get to the true cash balance. So in the income statement, the non-cash items here are going to be depreciation expense. So I'm going to put over here depreciation expense because the first item that we need to present under the indirect method in the statement of cash flow, that's your net income. Second is going to be your non-cash items, which is going to be from the income statement. So depreciation expense is going to be next. Depreciation expense, and it's going to be for $24,000. So we're going to add 24,000 to net income. All right, because this is a non-cash item here. The reason why it's non-cash is because when you do acquire a long-term tangible asset, it will have wear and tear, which is reflected by recording depreciation for it. When you record depreciation expense, no cash is being exchanged, but it is an expense that is affecting the net income, the bottom line. So in order for you to actually adjust it to where you can get to the true cash balance, you have to add back the $24,000 that was initially subtracted in order to get to the bottom line of net income. So you need to add that back in. So that's depreciation expense. And the next two items or last two items are going to be under other gains and losses, which are your loss on sale of plant assets. Let's see, loss on sale of plant assets. And that came out to be $6,000. So that's a loss. So since that's a loss, and it looks like an additional information here, I know you can see here on the screen, it says sold plant assets with a book value of $8,000, which is the, let's see, the original cost of it was $20,000 with accumulated depreciation of $12,000 for $2,000 cash, yielding a $6,000 loss. That loss did affect the bottom line of $38,000 in net income. So we're going to have to add back that loss of $6,000. So it affected the bottom line, but it is a non-cash item here. It didn't affect cash. And again, our goal when preparing a statement of cash flow is to get to the true cash balance, because whatever's presented in net income, that's presented using the accrual method and not the cash method, which is why we have the statement of cash flows. And then lastly, we're going to put in our gain on retirement of notes. Okay, so let me see here. There's some additional information here. It says they paid $18,000 cash to retire notes with a $34,000 book value, yielding a $16,000 gain. Well, that gain did affect the net income balance of $38,000 or amount of $38,000. So it increased that amount. But this is a non-cash item here. A gain on retirement of notes, that's non-cash. It didn't affect cash. So we're going to have to, since it did increase the net income, since it didn't affect cash, we're going to have to subtract 16,000, right? Yep, 16,000 from net income to get to the true cash balance. So this is the first two steps. First, display the net income. Second, display the non-cash items presented in the income statement. So next we can go ahead and present our change in current assets and liabilities. All right. So now we're going to shift gears and pivot over to the balance sheet. Okay. So on the balance sheet, we have our current assets and current liabilities. We're only focused on those sections. So for current assets, we have cash. Well, we're trying to get to the true balance of cash anyway, so we're not going to use cash here at all because, well, this is the statement of cash flows, and we're trying to get to the true balance of $17,000 at the end of the day once we include all of the other activity sections, which are investing and financing sections. So now we drop down to the second one here, accounts receivable. All right. So accounts receivable, we see that in 2020, it was $40,000, but in 2021, it increased by $60,000. So yes, this is a $20,000 increase. Now, the thing about accounts receivable is that if it does increase, that tells you that this was an increase in credit sales. So since this was an increase in credit sales, this did affect the net income of the bottom line positively. So since it did, and this is a credit increase in credit sales, and we want to get to the true cash balance, that $20,000 increase is going to be subtracted from net income. All right. So I'm going to put on here increase in accounts receivable. And this is actually going to be, again, a subtraction of 20,000. Now I'll show you all at the end of this recording a little trick to determine whether you need to increase or decrease to get to the true cash balance from net income and things like that. So, but yes, this increase in accounts receivable is going to be a subtraction because this is an increase in credit sales, which means that you didn't collect enough cash from receivables, which means that you need to go ahead and reduce or subtract the 20,000 from net income. All right. Next, we have inventory. So we see that inventory has an increase in $14,000. So increase in inventory of $14,000. Okay. So when it comes to inventory, when you increase inventory, that means that you acquired more or purchased more inventory. Since you acquired more inventory, that means that you need to go ahead and decrease the amount from net income. You used more cash than what was sold in inventory, meaning that you purchased more inventory than what was sold, which is why you have a $14,000 increase in inventory. Because you had $70,000 in inventory in 2020, and then $84,000 in 2021. So you acquired more than what you received in cash, which means that the cash amount is going to have to, or $14,000 is going to have to be a decrease from net income. Because again, we're trying to get to the true cash balance. Okay, next we have also an increase in prepaid expenses. So prepaid expenses, this could be a consolidation of supplies, rent, insurance. So it doesn't specify if it's prepaid rent or prepaid insurance or supplies. Now, if prepaid expenses increase, which it did by 2000, this tells you that more cash was paid than what was used up. Since more cash was paid than what was used up, which reflects the $2,000 increase in prepaid expenses, you're going to have to decrease $2,000 from net income. Okay. These are your current assets. Now we're going to go to the last section, which are going to be your current liabilities. So we drop down to the current liabilities in the balance sheet. We have accounts payable, and this will be a decrease in accounts payable. It looks like it decreased by $5,000. So at first it was $40,000 in 2020, 2021, and it was $35,000. So this tells us that more cash was paid to settle obligations, to settle liabilities. So since more cash went out, which reflects the decrease in accounts payable, we're going to have to subtract 5,000 from net income to get to the true cash balance. Next, we have interest payable. And that's going to also be a decrease in interest payable. So we see that there's a decrease in interest payable from 4,000 to 3,000, similar to accounts payable. More cash went out to pay down that interest. Since more cash went out, we're going to have to decrease $1,000 from net income to get to the true cash balance. Okay, lastly, of our current liabilities, we have income taxes payable. So income taxes payable shows an increase in that account. So increase in income taxes payable from 2020 to 2021. So since there's an increase in taxes payable by $10,000, so from 12,000 in 2020 to 22,000 2021, that increase means that more income taxes is owed than the cash that was paid out on those income taxes. So because the payable account increased, the company owes more. All right, they owe more in cash. So which means that the cash didn't go out yet because the payable account increased by 10,000. So since that's the case, we're going to add back $10,000 or add $10,000 to net income. All right. So zooming out here, let's go ahead and label this as current liabilities. All right. So when you do the math to get to, let me scroll up here. If it lets me, there we go. To figure out what the net cash provided, hopefully it's provided. Hopefully it's a positive amount. If it's not a positive amount, it will be net cash used by operating activities. So I'm going to say provided here. When you do the math to get to the net cash provided by operating activities, because that's the goal, we're trying to get to the net cash amount. We're going to take the net income of 38,000 plus or minus all of the non-cash items here. Okay, this is your non-cash items. Okay, plus or minus your current assets, plus or minus your current liabilities. You should get $20,000 as a positive amount. Okay. Now, I'm not sure if you noticed, there's a trick here to figure out whether you need to increase or decrease from or add or subtract from the net income here. when it comes to determining it from current liabilities and current assets. So for current assets, let me put it over here. There's a little trick. All right. So current assets. So you notice here in current assets, we have three of them. We have accounts receivable, inventory, and prepaid expenses. You notice that they're all increase. This is an increase here. Increase in AR, accounts receivable, increase in inventory, increase in prepaid expenses. But you notice that each one is subtracting from net income. Okay, so which means that to adjust to adjust net income to cash. Let's see if I can set this up properly. If there's an increase in current assets, subtract from net income. All right. If there's a decrease in current assets, you're going to add to net income. And when you are adding and subtracting to net income, you're doing it so that you can get to the net cash balance. Okay, that's the goal, to get to the net cash balance. Okay, now we scroll over here to current liabilities. So for current liabilities, you see that when there's a decrease in accounts payable, you are going to subtract from the net income or from net income amount. If there's an increase in a liability, you're going to increase or add to the net income. Okay, so I'm gonna put over here, increase in current liability. Add to net income. Decrease in current liability. Subtract from net income. All right. So this portion here for current assets, there's an inverse relationship. Current liabilities, this is a direct relationship. All right. So hopefully this little trick helps.